Again, welcome to the national webinar brought to you by the Entrust Group. The focus of this webinar is on contributions, since it is that time of the year where individuals are deciding whether or not to contribute to the retirement plans of their choice. My name is John Paul Ruiz, again, Director of Professional Development at the Entrust Group. Before we get started with the material, I would like to briefly talk about who the Entrust Group is for those of you who are attending this seminar brought to you by our organization for the very first time. The Entrust Group is an administrator / record keeper of retirement plans focusing on the alternative investment world, meaning the self-directed types of retirement plans that offer a record-keeping platform for those individuals that would like to invest in items such as real estate, precious metals, some of the pieces of investments that are not commonly found with some administrators. We've been in the business for over 30 years, and we process around 12,000 to 6,000 transactions every month and manage nearly $4 billion in investor assets. Now, our organization is comprised of individuals that are knowledgeable. Our organization puts forth and invests in our employees, including earning the CISP designation, which is a Certified IRA Service Professional designation that is a part of the American Banking Association. Our education providers, in other words, are individuals focusing on educating our clientele as well as producers that offer these types of accounts to the marketplace, are members of that CISP designation and are, in some cases, approved providers for certain continuing education that's necessary for licensing, such as real estate license, CFP, Certified Financial Planners, et cetera, et cetera. They do provide national and local events in person, so if you're interested in one of those types of events, please connect with us and see if we could bring one of those speakers to a function that you may have. We also do have local offices that may be near you, so please connect with the Entrust Group if you're interested in one of those. I'd like to emphasize the fact that the Entrust Group is this portion of the Entrust Group that provides education to the public is not offering investment advice nor endorse any products. In other words, the information that we're providing is purely informational to help you, the end consumer, make an informed decision on the type of retirement plan you're choosing to contribute to. Again, all educational material that you will receive are for educational purposes only. And all parties are still encouraged, highly encouraged, to consult with your tax advisors, attorneys, accountants, financial advisors before entering into any type of investment and or choosing any type of retirement account that you choose to contribute to. Now again, the focus of this particular webinar is on contributions. It is almost tax return due date time. It is good to refresh ourselves in the different types of contributions that can be made into different types of accounts, as well as the different characteristics that each account brings for us to make the appropriate decision on what type of account to contribute to. The agenda for today's course, first, we'll give you an overview of the different types of retirement plans, a refresher for some who may not understand the difference or may need to be reminded of the differences between the different types of buckets that you could actually contribute to. Some are individual accounts. Some are employer-sponsored plans for those of you who are also entrepreneurs or sole proprietors or maybe own a company that may be contemplating and choosing to contribute on behalf of yourself and or your employees if you have employees. We'll take a look at who is eligible to contribute as well as the additional tax advantages of contributing to these particular types of accounts. We will review the basics of contributions, the deadlines, what happens if you over-contribute. Those are essential components that need to be addressed in this particular seminar. So if an individual fails to satisfy the requirements, what do you do? We'll talk about how to treat an excess contribution as well as the penalties that may be involved by failing to correct such excesses or contributions that were not eligible to be made. And last but not least, once an individual decides to contribute to a particular type of retirement plan, well, what can you invest in? And last but not least, we'll summarize everything that we've talked about within the seminar. Now, briefly, this seminar will last approximately an hour long, with the first 35 minutes to 45 minutes, focusing on the presentation material. In other words, we're going to focus on content. The last 15 minutes or so, 10 to 15 minutes or so, we're going to open up the phone lines for any questions you may have in regards to the material that has been presented. So please, as we go through the material, jot any questions you may have down, because we're going to open up the phone lines later on for any questions you may have in regards to what I presented. All right. Let's take a look at the different types of retirement plans that are available to contribute to. Now, there are other accounts that we're going to be talking about that are not necessarily retirement plans, but individuals may have used these accounts to save up for other reasons. And most administrators that deal with IRAs also administer these accounts. And those are your education savings accounts as well as health savings accounts. But the focus of this seminar will deal mainly with individual accounts called a traditional IRA and a Roth IRA, as well as small business accounts focusing on simplified employee pension plans, also known as your SEPs, as well as your savings incentive match plan for employees, also known as your simple plan. Although not an IRA employer-sponsored plan, and the Entrust Group does record keep a qualified retirement plan called an individual K plan, which is designed for small businesses. So we're going to cover that piece as well. Then as you try to compare the difference between the three and what best fits you, we will have a little bit of more information to offer to you to provide that side-by-side comparison on these three different types of small business plans. Again, as mentioned earlier, we are going to cover the education savings account as well as the health savings account. Briefly, what is a Roth IRA? The Roth IRA has a component that was created under the Taxpayer Relief Act of 1997, that an individual can contribute to this account having the same limits as a traditional IRA. However, the characteristics involved are as follows. The contribution being made may not be used as a tax deduction. In other words, the contribution that is being made will be viewed as having been taxed already. Then what's the benefit of a Roth IRA? One of the benefits of a Roth IRA is the fact that the earnings will not only grow tax deferred. In other words, it will grow in a more rapid pace, given the fact that the earnings that that the Roth contributions are invested in will not be taxed while it's sitting under the Roth IRA. Another big benefit of the Roth IRA is that if the individual satisfies certain criteria, in other words, has satisfied certain rules, the earnings may be distributed upon satisfying those criteria tax-free. In other words, again, the earnings grow tax-deferred in a Roth and eventually may be distributed tax-free. The criteria that needs to be satisfied in order for the earnings to be distributed tax-free are as follows. Number one, you must have had a Roth, any Roth. In other words, the moment you contribute to a Roth, that starts your process of possibly getting your earnings distributed tax-free. Once you contribute to a Roth, it starts a clock. The clock starts for all of your Roth the moment you contribute to any Roth. As a matter of fact, the clock starts as of January 1st of the year for which the contribution is made. Starting that clock, after the individual satisfies a 5-year rule, in other words, after the 5th year, 1/2 of the criteria to determine distributing earnings tax-free has been satisfied already. In other words, 1/2 of the rules that need to be satisfied is that you must have had a Roth for at least 5 years. The other half of the rules or the criteria involve the fact that the individual must satisfy one of the 4 events: attaining age 59.5, which is date-specific, death, disability, and up to $10,000 of the earnings if it's used for purchasing a first-time home. Those earnings that are distributed after satisfying the 5-year clock in one of the 4, the earnings will be distributed tax-free. That's a big thing to place in consideration in determining whether or not you would like to contribute to a Roth or a traditional IRA. We'll cover traditional IRAs in a second. But as a recap again, in a Roth IRA, there is no immediate tax benefit for the contribution, given the fact that the contribution may not be used as a tax deduction. However, the growth on the contribution inside a Roth IRA will not only grow tax deferred, but may also be distributed tax-free if the individual satisfies the 5-year clock as well as one of the four: death, disability, attainment of 59.5, as well as up to $10,000 of the earnings may be distributed tax-free if used for purchasing a first-time home. Now, unlike a Roth IRA, a traditional IRA, which was created under the Employer Retirement Income Security Act of 1974, the oldest individual retirement account that we have in existence, a traditional IRA's contribution may be used as a tax deduction. Now, when I say maybe, in other words, it's not always tax deductible. There are certain questions an individual might want to ask, and those are the pieces that we'll cover as we get to explore the benefits of a traditional IRA later on in this course. But if an individual contributes to a traditional IRA and they can use it as a tax deduction, the traditional IRA contribution will reduce the taxable income of that individual for the year. So in most cases, if it's tax deductible, the contribution that they make has never been taxed before. That's one of the big benefits individuals are really looking for. A traditional IRA gross tax deferred, similar to the Roth IRA. In other words, an earnings on the investment is not going to get taxed until they take it out. What's the moral of the story? Don't take it out. That's why most individuals who have retirement plans, when they contribute, they don't touch it. However, once the individual distributes those earnings as well as the contributions that were used as a tax deduction, that amount will be includable in taxable income for the year. Now, the reason why we're covering the characteristics of these two types of retirement plans, individual accounts, is that in determining what contribution you would like to make for the year, whether it be traditional or Roth, it is good to know what the taxation is or what the benefits are at the end, because the type of IRA that you contribute to will determine the amount of assets you'll have at the end upon retirement. In a Roth IRA, even though you're paying the taxes on the contributions initially, assuming, of course, that the contribution is less than what you would end up later on based on the growth of your investment, well, the earnings as well as the contribution may be distributed tax-free in the end. Therefore, you might want to consider the benefits of a Roth IRA. Whereas in a traditional IRA, you do use it as a tax deduction, and the earnings do grow tax-deferred. But later on, when you distribute that, a portion of the distribution will have to go to Uncle Sam. Now, the next magical $2 million question a lot of people ask is, well, how much of that will be subject to tax? Well, the answer is we don't know. Depending upon how the tax laws are legislated in the United States moving forward, and of course, depending upon what you take it out and what tax laws apply, will determine how much of that traditional IRA you get to keep. But nonetheless, there are two choices an individual has in determining what type of contribution they would like to make for the year. Now, these are your annual individual retirement account contributions. There are also other types of contributions that can be made, such as your rollovers, your conversions, recharacterizations. But the focus on this particular course are your new contributions coming in, such as your annual contribution as well as employer contributions, which transitions us to the small business accounts. For employers that are entrepreneurs, or in other words, businesses that employ people, or in some cases just employ themselves, there are small business accounts or small business retirement plans that can be established by these small employers, such as your simplified employee pension plan. It just so happens that if an employer sets up a simplified employee pension plan, the contribution to these types of plans must go into a tax-deferred account. In 1978, Congress decided that the traditional IRA is the tax-deferred account that these simplified employee pension plan contributions will go into. Therefore, the contributions called SEP contributions that make it into a traditional IRA, which some institutions call it a SEP IRA, just to be able to delineate the fact that there are SEP contributions that may have hit this traditional IRA. These assets that are contributed to that account take on the traditional IRA characteristics. Now, another type of employer-sponsored plan that is available for small businesses is what we call the Savings Incentive Match Plan for employees. This was created under the Small Business Jobs Protection Act of 1996, which was designed for small businesses. Given the fact that unlike a 401k plan, which requires a lot of administration, especially if you have employees, called non-discrimination testing requirements, IRS forms that need to be filed, Savings Incentive Match Plans for employees, also acronymed as SIMPLES, do not have those types of requirements attached to it. However, there are certain mandatory contributions that are required that makes the employer responsible to make those types of contributions in order for them to maintain the plan. We'll cover a lot of those types of contributions later on in this course. And last but not least, individual K plans are your 401K plans intended only for owners, as well as owners and their spouses that are covered or working for the organization that they currently have without any employees. That's a key word right there, folks. Individual K plans will only work if an employer has no employees or no employees that are eligible to participate in the plan. Because the moment an individual or an employee or rank-and-file employee is eligible to participate in an individual K plan, that individual K plan just becomes a regular 401K plan, which I mentioned earlier will be subject to non-discrimination tests as well as required government reporting. The other two accounts, although not retirement plans, may be administered by an IRA administrator, so it's good to talk about it anyway. One of which is the education savings account, which the benefit is the contributions, the earnings and the contributions will not only grow tax deferred, but may also be distributed tax-free if used for education, elementary, post-secondary, as well as college, and so on and so forth. Health savings accounts are typically paired up with a small business account called, in other words, your SEP plans, your simple plans, as well as individual K plans. Why is that? Because these small businesses also, in most cases, need health insurance. In order for you to have a health savings account, you must have a high deductible health plan, which is one of the more cost-effective types of plans that a small employer could get, given the fact that the deductible limits are a little bit higher. If the high deductible health plan satisfies the federal criteria, the individual may contribute to a health savings account. Now, the characteristics of a health savings account are similar to your traditional IRA. Unlike a traditional IRA where the contribution may or may not be deductible, health savings accounts have a bigger benefit, which is a straight line deduction in the individual's tax return if the individual contributes to the health savings account. Unlike a traditional, again, which they have to ask questions, in a health savings account, you don't have those questions. Once you make a contribution, it's automatically tax deductible as a straight line deduction on your Form 1040. The interest also grows tax deferred. In other words, it's not going to get taxed while it's inside a health savings account. And if distributed for medical purposes, for medical expenses, the interest will be distributed tax-free. What does that sound like, folks? It sounds like a traditional IRA, right? However, the bigger benefit is the fact that when the earnings are distributed and the contribution is distributed for medical purposes, the distribution is tax-free. Along with that, the 10% early distribution penalty is waived once a person reaches the metrical age of 65. A little bit different than your traditional IRA, which has the exemption kick in upon attainment of 59 and a half. Health savings account penalties are waived when a person reaches age 65. Now let's take a look at these individual accounts in greater detail. Who is eligible to contribute to a Roth IRA? There are typically two things to look at to determine whether or not an individual can contribute to an individual account, one of which is an age limit as well as an income limit. In a Roth IRA, there is no age limit. In other words, a person who is age 75 but still has earned income, in other words, they're still working, still has the privilege of contributing to a Roth IRA, assuming, of course, that their income does not exceed certain thresholds. We'll review what those thresholds are in the next slide. Again, to contribute to a Roth IRA, the individual can be any age. However, as long as they have earned income, we'll take a look at what is and what isn't earned income in the next slides as well as also that their earned income or their income does not exceed certain limits, well, then they're eligible to contribute to a Roth IRA. Now, once an individual determines that they're eligible to contribute to a Roth IRA, let's say they're married. However, the spouse of this individual does not have earned income, but they file a joint tax return. The individual who does not have earned income may still make a contribution as long as the married couple, number one, files a joint tax return. In other words, they don't file a separate return for each individual, but they file a combined return called a joint return. And also, as long as their income will support the contribution that they're going to make for the year, then the individual who does not work can make what we call a spousal contribution. Now, there is no such thing as a spousal IRA. This term spousal contribution is just a term for the characteristic that I just described. Again, for Roth IRAs, there is no age limit. The individual must have earned income, in other words, wages for services performed, as well as the income of this individual may not exceed certain limits. Spousal contributions for those individuals who don't work but is married to one who does work, as long as they are a couple married filing a joint tax return, each individual may set up their own individual Roth IRAs. By the way, it is required to set up their own individual Roth because there's no such thing as a joint Roth. And those individuals may contribute up to the amount that they're eligible to contribute. Now, what defines the income thresholds for Roth IRA eligibility? Here are the income thresholds for year 2013 and 2014. Why are we still talking about 2013? Because individuals can still make their contributions up until the tax return due date, not including an extension, for, in this case, 2013. The typical deadline for an individual is April 15th to make that contribution. Therefore, they can still allot or designate that contribution for the prior year. For single individuals, here are the income thresholds. If the modified adjusted gross income of an individual is less than $112,000, even though they have income that appears to be quite a bit, they can still make a Roth contribution. The moment their modified adjusted gross income exceeds 112 and goes between 112 and 127, they can only make a partial Roth contribution. If it exceeds 127,000, then they will no longer be eligible for that Roth IRA. That's how these income limits that we're looking at is applied to determine eligibility. For a married couple filing a joint tax return, if the modified adjusted gross income is below $178,000, the individual or the individuals can still make a full Roth contribution. Between $178 and $188, they can make a partial contribution. And then if it's over $188, the individuals have exceeded the income limits, therefore they're not eligible to contribute for the year. Now what happens between $178 and $188? Let me give you an example. Let's say the couple's income is $183. In other words, $183 or halfway between $178 and $188, halfway or 50%. That tells us that out of the maximum contribution for the year that's allowable under the code, then the individual can only make up to half of that amount. If the individual could only make up to half of that amount, where would be the best place to put the other half? Well, we're going to talk about another type of IRA that they can contribute that amount to. Again, this income limit determines the maximum amount that an individual can make, even if they exceeded the lower threshold of these income limits. For married couples filing a separate return, it's almost impossible to make a contribution, given the fact that the married couple filing a separate return is already getting a tax break according to Congress. Then these individuals will have a lower threshold to determine their eligibility to contribute to a Roth IRA. Again, these dollar figures are the ones that are used by your CPAs or tax preparers to determine the eligibility of an individual in determining whether or not they can make a contribution to the Roth IRA. Now let's take a look at the traditional IRA. As mentioned earlier, there are typically two criteria that an individual must consider to determine whether or not they're eligible to contribute to these individual accounts, same as in a traditional IRA. The age limit, however, in a traditional IRA is 70 and a half. Let me further define what that means. If an individual is going to turn 70 and a half in a particular year, in other words, if somebody's going to have a birthday, as an example, in February of a given year, which means they will turn 70 and a half that year, they will not be eligible to contribute at any point during that calendar year any longer. On a contrary to that, if somebody, let's say, is turning 70 in October, that tells us obviously that this individual may still be eligible to contribute even though they're turning 70 that year, because they won't turn 70 and a half until the following year. That 70 and a half rule is a big delineating factor in comparison to a Roth IRA. If you may recall, in a Roth IRA, there is no age limit. In a traditional IRA, there is one. The individual must also have earned income. IRS calls it as taxable compensation. In some cases, the individual may have taxable income, but they're not subject to taxes because they don't make enough. So that's another way to phrase that. The reason why I'm saying that is, although some of you who may be attending the seminar may be saying, I make too much money to contribute to this, or I don't really need to contribute to a traditional IRA because I can't use it as a tax deduction, as an example. Don't forget that you do have family members that may be eligible to contribute. And a good way to be able to assist them in their retirement savings efforts is to possibly assist them by providing a contribution on their behalf, assuming, of course, that they are eligible to make that contribution. As you may notice, in a traditional IRA, there is no income limit to make a contribution. An individual who makes $1 billion, as long as they're under 70 and a half, in other words, they have earned income, they can make a contribution to the traditional IRA. One of the things that is typically confused in regards to receiving advice from some individuals is that somebody might say, well, you make a lot of money, and you might not want to consider a traditional IRA because you may not be able to use that contribution as a tax deduction. I'm going to stop here for a second. A tax deduction is different than the eligibility to contribute. An individual may still contribute even though they cannot use their contribution as a tax deduction. It just so happens that the contribution may not help them in their efforts to reduce their taxes for the year, but they can still make a contribution. Given the fact that, as I mentioned earlier, one of the biggest benefits of a traditional IRA is that the earnings will still grow tax deferred. How many accounts do you have out there where the earnings in your investment is not getting taxed while it's sitting under the umbrella of this tax deferred plan? Spousal contributions are also available for traditional IRAs similar to your Roth IRA. As long as the married couple is filing a joint tax return and they satisfy the eligibility requirements appropriately for the type of IRA that they're choosing to contribute to, as long as, again, they have enough earned income, they may be able to make a contribution to either one of these two IRAs that we're talking about, or both, as long as the combined contributions do not exceed that one limit. Now let's take a look at what the limits are for 2013 and 2014. But before we do that, let's take a look at the deductibility feature of an IRA. And what I mean by that is that not only must the individual consider whether or not they're eligible to contribute to an IRA, they might also want to ask the question, can I use this to help my efforts in reducing the taxation of my taxable income for the year? And this is what an individual would need to ask themselves. Number one, am I covered by an employer-sponsored plan? Another term for that is that, am I actively participating in an employer-sponsored plan? The reason why that magical $2 million question needs to be asked is because of a Tax Reform Act that was passed in 1986. If individuals are already participating in a 401k plan, as an example, a SEP plan, a simple plan, an individual K plan, just to name a few, the employer is already getting a tax deduction on behalf of that employee. If an individual also contributes to an IRA, Uncle Sam says, we need to take a look at this individual's modified adjusted gross income to determine whether or not their traditional IRA contribution may be used as a tax deduction. However, contrary to that, if an individual is not covered by any one of these plans, well, this particular rule does not apply. For a single active participant in an employer-sponsored plan, in other words, let's say Joe is a single active participant in a 401k plan, Joe would need to take a look at this table to determine whether or not his contribution is tax deductible. If his modified adjusted gross income falls below $59,000 for 2013, not only can Joe participate in a 401k plan, contribute to a traditional IRA, that contribution to the traditional IRA may also be used as a tax deduction. Now, the moment Joe's income exceeds $59,000 in increments of $1,000 in this case, it reduces his eligibility to deduct that contribution by 10%. Now, for married couples filing a joint tax return, it's between $95 and $115. Under $95, fully deductible. Between $95 and $115, partially deductible. Over $115, no deduction at all. For every $1,000 it goes over $95, it reduces a married couple's filing a joint tax return's deductibility by 5%. I think you get the point. Now, there is a special circumstance called a spouse of an active participant. What does that mean? Maybe you have a husband and wife. One participates in an employer-sponsored plan. The other one doesn't. What does that mean? The one who doesn't participate in an employer-sponsored plan, by virtue of being married to somebody who is participating in an employer-sponsored plan, will be deemed to be participating in an employer-sponsored plan. In other words, they're penalizing that individual for falling in love. If somebody's married to someone who is participating in an employer-sponsored plan, they're automatically deemed to be participating. Therefore, they will be subject to income limits to determine deductibility. However, to determine the income or to determine the deductibility of that contribution for the one who is deemed to be active or covered, the income thresholds are a little higher. If you take a look at 2013, it's between $178 and $188. In other words, for the one who is deemed to be participating, they have a higher income limit to determine deductibility. Below $178, fully deductible. Between $178 and $188, partially deductible. Over $188, no deduction at all. Now, I'm going through this pretty fast. Keep in mind, because we're not giving you tax advice nor telling you how to calculate this thing. But at least we're giving you some basic principles to determine, at least eyeball, what questions to ask, and number two, how the basic principles work. On the back of your Form 1040 is a worksheet that assists an individual to determine the deductibility of their IRA contribution. That's one place to look. As well as, again, go seek the assistance of a competent tax advisor, attorney, or advisor that can help walk you through to determine the deductibility of your traditional IRA contribution. Now, let's get into the maximum contribution for 2013 and 2014. There has been no change to the contribution limit for 2014 in comparison to 2013. It's $5,500. Now, for individuals who attain age 50 before the end of their taxable year, they get an additional $1,000. And let me qualify that age 50 rule. If an individual is age 49, can they make a contribution called a catch-up or an additional contribution? Not a mustard, but catch-up contribution? The answer is it depends. It depends upon whether or not that individual will turn 50 before the end of the taxable year. However, if they're 49 and they have a birthday before the end of that taxable year, they can go ahead and make that catch-up contribution. Therefore, for an individual who's age 50 and over, their maximum contribution is $6,500, unless, of course, their earned income or taxable compensation is less than that. Let me give you an example. If you have a married couple and their income is only $2,000, although the thresholds allowed by Congress is a lot higher than that, they are going to be limited by the amount of taxable compensation that they have to base their maximum contribution amount for the particular year. In this case, the maximum amount that they contribute for the year is only $2,000 because they don't have enough earned income to support that full contribution. Now, don't get earned income mixed up with all sorts of other incomes called passive income, because the thing that Congress looks at to determine the eligibility of an individual for contribution purposes is what we call earned income. In a publication called Publication 590, published by the Internal Revenue Service, it has in there in this publication what is and what isn't considered taxable compensation or earned income. Of course, let's take a look at the list of obvious taxable compensation: W-2 wages, tips, professional fees, commissions, and bonuses. Self-employment income, of course, if it's a positive. Alimony and separate maintenance. In other words, if an individual is receiving alimony and the person paying the alimony uses as a tax deduction, the recipient can use that as earned income. Military differential pay, non-taxable combat pay for those who are serving our country in military. What isn't considered as taxable compensation? Earnings and profits from property. In other words, rents and royalties. Interest and dividend, pension and annuity income, deferred compensation, income from certain partnerships called passive income, and last but not least, self-employment laws. It is good to seek out the assistance of a tax advisor to determine whether or not an individual has earned income to determine their eligibility for contribution purposes. Now, when is the deadline to make a contribution? The deadline to make a contribution is the tax return due date of an individual, not including any extensions, and that deadline is April 15th. Now, if an individual is going to make a contribution now for 2013, the individual must notate somewhere in writing to the custodian of choice what year their contribution is for. Because if they don't make that indication, then the custodian will report that contribution for the year in which the contribution was made. In this case, it might cause some tax problems for that taxpayer by neglecting to notify the custodian of what year the contribution is for. So if somebody's making a contribution, make sure you tell the custodian specifically for what year that contribution is for. Now, we've gone over a lot of these rules. To determine who's eligible to contribute, et cetera, et cetera. Now, when we take a look at the contribution basics, what if someone, let's say, fails to satisfy those rules? In other words, let's say what if an individual contributes more than the annual limit? Or what if the individual does not have enough earned income? Or what if the individual exceeds the age limit to contribute to a traditional IRA? Or what if the individual exceeds the income limit for the Roth IRA? If someone fails to satisfy the requirements, the contribution or a portion of the contribution in some cases, that is what we call an excess contribution, the individual has to decide one of two things. One option to treat an excess is, number one, distribute the excess contribution. Of course, the earnings associated with it as well must be distributed and has to be distributed by the tax return due date plus extensions of that individual in order for them to avoid what we call a 6% penalty. The 6% penalty is based out of the amount of excess. If an individual has a $1,000 excess, they pay $60 to the IRS using an IRS Form 5329, and voila, they basically paid that penalty. The second option of treating an excess is not taking out the excess and, as I mentioned earlier, just paying the 6% penalty. And the reason why it's an option is because Uncle Sam says by paying the 6% penalty on the excess, number one, the excess doesn't have to be distributed, nor the earnings must be distributed. And number two, the excess contribution that remains in that person's IRA gets carried forward to the following year as if the individual made a contribution to the following year. It's a little bit simpler way of handling an excess in the event that it's feasible to treat it as such. In other words, if an individual can afford to pay the 6% penalty, and they don't want to have to distribute the particular investment, well, just pay the 6% penalty and that contribution gets carried forward to the following year. There are two options, again, on how to treat an excess made in a traditional IRA and or a Roth IRA. One is distribute the excess as long as it's distributed by the tax return due date plus extensions, or pay the 6% penalty and carry forward that excess as if they made a contribution for the subsequent year. Now, again, if you have an excess contribution, these are just basic rules that we're talking about. It's still highly recommended to go seek the assistance of a competent tax advisor or attorney that basically guides an individual through tax situation. Recap: annual contributions must be deposited from personal funds. In other words, it has to be cash. It cannot be property. It can be a wire check, ACH, however it may be, but it has to be in cash. There is a limit on the amount that can be contributed. However, these amounts may be increased from year to year due to cost of living adjustment, and we haven't had any change for 2014. Contributions must be made by April 15th. In other words, the tax return due date of an individual. Now, if April 15th falls on a weekend or a holiday, the code does allow for us to have the following business day as the ultimate deadline. Again, there is no extensions to this April 15th. contribution is reported to the IRS using what we call an IRS Form 5498, which not only does the IRS get a copy of the IRS Form 5498, the taxpayer as well receives a copy of that. Additional IRS forms may be filed with an individual's tax return. As I mentioned earlier, if an individual makes a contribution to a traditional IRA, in some cases it may not be used as a tax deduction. Therefore, if it can't be used as a tax deduction and the individual is going to pay taxes on that contribution, it may be to their best interest to keep track of that contribution. There is an IRS form. You might want to jot this down. It's called an IRS Form 8606 that needs to be filed with the IRS to keep track of those dollars that have been taxed already as made to that traditional IRA. So upon distribution, it doesn't get taxed again. The moral of the story is if that 8606 is not filed, well, then there's no record that that contribution was never used as a tax deduction. Now let's proceed on and talk about employer-sponsored plans. All right, let's take a look at employer-sponsored plans. The employer-sponsored plans we're going to cover for this particular seminar are your simple plans, your SEP plans, as well as later on we'll cover the individual K plans. These small business plans are designed for sole proprietors, partnerships, as well as S Corps and C Corps. In other words, entities that file as an employer. For SEP plans, there's no limitation on the number of employees that you may have, but contributions that are made on behalf of the employer must be the same as what's provided to eligible employees. An individual or an employer may also establish and fund the plan until the employer's tax return due date plus extensions. Why did Congress make it that way? Because in some cases, as an example, a sole proprietor, they may not know whether or not they made money for the year to determine whether or not they even want to make a contribution for the year. Therefore, the deadline to establish that plan is up until the employer's tax return due date plus extensions. At that point, Uncle Sam says, as the moment you figure out whether or not you made money that year and you actually want to make a contribution to the retirement plan, we'll give you up until your tax return due date plus extensions, not only to establish the plan, but also fund it. Unlike a SEP plan, there are strict deadlines on when to establish a simple plan. A simple plan must be established generally by October 1st of a particular calendar year. In other words, if an individual wants to establish a simple plan for 2013, it will be too late. There is also a limit on the number of employees an employer may have to establish a simple plan, and that number is 100 employees who earn at least $5,000 in the preceding year. If an employer exceeds that 100 employee limit and they already have an existing plan, they may still run that plan for an additional 2 years, but after that, and maintain that over 100 employee amount, then they may no longer maintain that simple plan. Uncle Sam says you need to transition to a different type of plan, and that's where the 401k plan comes in. In a simple plan, since there is no discrimination testing requirements, the employer also is prohibited from establishing another plan that they're contributing to in the same year. In other words, you can't have a 401k plan and a simple plan. But these small business plans have distinct characteristics. SEP plan, as you noticed already, can be established at a later date, whereas simple plans have a distinct deadline of October 1st of a particular year. There are some exceptions to that for a brand new business, however. Now let's take a look at the characteristics on who may be eligible to contribute to a SEP plan and a simple plan, starting off with a SEP plan. The employer may, in other words, they don't have to, but they may impose restrictions on who can participate in the plan. Now keep in mind the employer is also subject to these rules. If they impose it on employees, they impose it on themselves. The first criteria is that they can impose an age requirement. The maximum age requirement is age 21. It can be less than that, but it can never be more than that. The employer can also require that the individual work for the employer at least 3 out of the immediate 5 preceding years. In other words, or 3 of the last 5 years has the employee worked for this employer at least an hour in any one of those years. If they do so, they have satisfied that service requirement. Last but not least, since these small employers may employ certain individuals called seasonal employees, the employer could also impose a current year compensation limit to determine whether or not that individual will receive a contribution for the year. Let's say an employer has a seasonal employee that only works for the employer 1 day out of the year. If the individual does not make at least this minimum compensation, they will not receive a profit sharing contribution for the year called a SEP contribution. In other words, there are certain criteria that an employer could impose on employees that would exclude them, number one, from participating in the plan. Number two, may also exclude them from receiving a contribution. Simple plans also have a certain criteria that an employer could impose, such as a service requirement. The maximum service requirement in a simple plan is 2 years. It must also be expected to receive a certain dollar figure for the year, which could possibly help exclude those individuals that are called seasonal employees from being able not only to participate but also receive a contribution. However, unlike a SEP plan, there is no age requirement on a simple plan. The maximum contribution for a SEP plan is the lesser of 25% of each eligible employee's compensation, not to exceed a certain dollar figure. In 2013, the maximum dollar figure is $51,000, and in 2014, it's $52,000. There is a publication called Publication 560 that an employer can go to get these rules, as well as go through the worksheets to determine the maximum contribution that they can make for the year. Let's give you an example. In 2014, it's the lesser of 25% of compensation, or $52,000. If an employee's compensation is $100,000, the lesser of the two would be $25,000. Why is that? Because that's 25% of the employee's compensation. If the individual makes, let's say, $250,000, then we know fully well that the lesser of 25% of compensation, or $52,000 for 2014, would be $52,000. That's the exercise that the employer would have to conduct to determine their maximum contribution to a SEP plan. In a simple plan, since it's a little bit different than a SEP plan, because it does include two different types of contributions, an employee contribution and an employer contribution, the thresholds are a little bit different. Simple plans are similar to your 401k plan, where the participants can actually defer or contribute from their own paycheck. Contributions from their own paycheck are what we call elective deferrals. In lieu of having to run a discrimination test in a simple plan, Congress mandates that the employer make their own contribution, and they can choose either one of the two. Either a non-elective contribution, called a profit-sharing contribution, or a matching contribution, which matches the contributions that are made by employees. The employee elective deferrals in a simple plan has a maximum of $11,500 for 2013 and $12,000 for 2014. The reason why we're still covering that right now is because in some simple plans that are only covering the employer, their contribution can be made up until their tax return due date plus extensions. If an individual is at least age 50, they can also make an additional $2,500, of course, assuming that their compensation would cover that particular additional amount to make that contribution to a simple plan. Again, it is good to seek out the assistance of a competent tax advisor, not only to understand these plans, but also to determine what type of contribution they're going to make and the maximum amount that can be made into these plans. Now, individual K plans are 401k plans designed for owner-only types of employers. In other words, sole proprietors with no employees, or corporations with no employees, partnerships with no employees, that only cover the owners, their spouses, and other owners. Individual K plans do have higher limits. That's why most employers would choose 401k plans. Let's take a look at those limits. The maximum deferral in an individual K plan for 2013 is $17,500, with no change for 2014, with an additional $5,500 for those individuals who at least attain age 50 before the end of their taxable year. In addition to that, since it's an individual K plan, the employer could also make an additional profit-sharing contribution, which is the lesser of 25% of compensation, or $51,000. In other words, not only you get the deferral piece, you can also put that employer piece in an individual K plan, thus therefore maximizing the amount that can be backed away in these particular accounts. Now, once an individual decides what type of contribution they're going to make, what can they invest in? Of course, along with the fact that they can invest in the common types of investments, CDs, money market accounts, stocks, bonds, mutual funds. In the Entrust Group, since we focus on alternative investments, The individual could also invest in other types of investments, such as real estate, whether it be residential or commercial, precious metals, limited liability companies, limited partnerships, secured and unsecured loans. In other words, almost anything. However, in the IRA world, there are certain restrictions on what types of investments IRA assets can be invested in. And those are your collectibles, life insurance, and last but not least, that's corporations. Keep in mind, although I mentioned precious metals earlier, that there are limitations on the type of precious metals that can be invested in an IRA. Additional types of contribution limits that we're going to talk about in this particular course, as mentioned earlier, are your non-retirement types of plans. However, may be used as a retirement plan by certain individuals since it has a certain characteristics similar to your retirement plans called health savings accounts. Let's take a look at the Coverdell and the HSA savings accounts. All right? Coverdell education savings accounts, again, are intended for education. Contribution limits will not change unless there's an act of Congress. The maximum amount is $2,000 for 2013 and 2014. Health savings account contribution limits, however, may change from year to year because it is subject to cost of living adjustments. For individuals that are covered under a single coverage high deductible health plan, the maximum for 2013 is $3,250 and $3,300 for 2014. For family coverage, it's $6,450 for 2013 and $6,550 for 2014. Why are we talking about 2013 and 2014? Because the deadlines for these types of contributions can be made up until the tax return due date of the individual, not including extensions. The same deadline as your IRA types of accounts. Now, to summarize what we just covered, the deadline for contributing to IRAs is the tax return due date of an individual, not including any extensions. There are limits to the dollar amount that can be contributed to these different types of accounts. Contributions to traditional IRAs, along with your employer-sponsored plans, such as your SEP, Simples, and individual K plans, may be deductible and, importantly, grow tax-deferred in these accounts. Although Roth contributions are not deductible, the good part about Roths, again, is that the earnings not only grow tax-deferred, they may also be distributed tax-free in the future. Now, how do you set up these accounts? Open up an Entrust account, fund your account, and then choose the type of investment that you'd like to invest those assets in. Now, when we start taking a look at these accounts at Entrust, not only are we talking about contributions. If you have existing accounts in another organization, we have a promotion up until March 15th that would allow for you to transfer your IRAs at other organizations to the Entrust Group absolutely free. In other words, we're going to waive the fee for a transfer that occurs between now until March 15th. Now let's open up the phone lines for any questions you may have in regards to the materials presented. I see that there are individuals that have questions for us. All right. The first question that I see here is, what is the latest age an individual can contribute to a Roth IRA? And the answer to that question is that there is no age limit in a Roth IRA. As mentioned earlier, although there is an age limit on the traditional IRA, there is no age limit on the Roth IRA as long as the individual has earned income. In other words, as long as they have wages for service performed and they are getting paid for those services that they perform, they have earned income, there is no age limit. And also, as long as the income of that individual does not exceed those modified adjusted gross income thresholds that we mentioned in previous slides. Now, another question that I have here is that is a total of $13,000 Roth contribution corrected between workers and not working spouses of over 65. Now keep in mind, when we start taking a look at the contribution limits, they are individual limits. So in other words, whether it be you have a working spouse, non-working spouse, keep in mind again that magical tax filing status of married filing a joint tax return. As long as a couple is married filing a joint tax return, has enough earned income to support the contribution, and also depending upon their age, the maximum contribution thresholds that we talked about are applied to each individual separately. $5,500 per individual plus an additional $1,000 for those individuals who have attained age 50 and over. In other words, $6,500 for each one of those individuals in their own individual accounts respectively, again, assuming, of course, they have enough earned income to support it and they do satisfy the eligibility criteria. Now, another question that we have here is that, can I purchase stocks with my self-directed Roth? Sure. You can invest in just about anything in a traditional IRA except for collectibles, life insurance contracts, as well as S-corps. Another question we have here is, can you contribute to a solo 401k for my consulting company even though I have a defined benefit plan to my employer? The answer is yes. As a matter of fact, let me give you an example. I had a client at one point say, this person works in Silicon Valley as a computer programmer and participates fully in their 401k plan. In that particular situation, the individual is an employee. They also moonlight in the evening working as a consultant, in other words, programming in the evening. This person must not have had a life, but they also work as an independent contractor to other organizations. In this case, the person's an employer. Similar to the situation, can they participate in an employer-sponsored plan if they work for somebody and also establish an employer-sponsored plan for themselves since they're a business? The answer is yes. There are limits, however, that come into play. That $17,500 that I mentioned, which is the maximum deferral limit in 401k plans, is an aggregate limit of all plans that this individual works for. In other words, once they max out $17,500 in one plan, they've used up their limit for the particular year. Those are the things that you might want to watch out for and ask your tax advisor to make sure that you monitor that amount. But yes, you can participate as an employee and you can also establish with one as an employer. Another question, may a single member LLC establish both a SEP IRA and an individual estate plan in a single year? The answer is yes, as long as the SEP plan is what we call a prototype document. In the SEP document that is provided by the IRS, there is a stipulation in there that you cannot maintain a qualified retirement plan in the same year. So therefore, what you would need to do is seek out a provider that provides what we call a prototype document where that language has been stripped out. Then you can have a SEP plan and an individual K plan in the same year. But without that scenario, you may not be able to using the government document. Is income Schedule C net income or gross income? First, the answer is it's net income. As a matter of fact, there's also an additional calculation that would have to go, that the sole proprietor would have to go through to determine the income that can be used for contribution purposes. And the calculation of that can be found on publication 560. For a non-working spouse, how much IRA or Roth IRA? For a non-working spouse, as long as they're married to someone who has enough earned income and they file a joint tax return, a non-working spouse can contribute the full amount just as much as the working spouse can, as long as their combined income as a joint filer would support the maximum contribution for the year. Now, there are no other questions that I see on the screen at this point. I hope that everybody learned something from this particular course, and I'm going to leave my name and telephone number and email if you would like to email me any questions you may have after this particular course. Again, on behalf of the Entrust Group, my name is John Paul Ruiz, Director of Professional Development. I thank you for attending today's course. And contact us if you have any questions in regards to the material we presented or any services that we provide at the Entrust Group. Again, my name is John Paul Ruiz, Director of Professional Development from the Entrust Group. I thank you for attending today's course.